Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, it's official. The U.S. Treasury plans to clean up $500 billion worth of bad bank assets, according to published reports under this new public-private investment program just announced. Taxpayer funds will be used to seed partnerships with private investors who will buy up toxic assets backed by mortgages and other loans. The stock market, for one, and the bank stocks, for two, surging ahead on the news. How do our analysts here feel about it? Let's find out right now. From Steve Reitmeister, editor-at-large, Tracy Reinick, value stock analyst, and top stock screener Kevin Matris, all from Zacks.com. So, Kevin, let's start at the far end this time.
Right.
How do you feel about it? I mean, everybody seems to be applauding it, yet there are still some unknowns.
Yeah, the market seemingly likes it. This all started last week when the FOMC announced that they're going to buy up to $300 billion of treasuries over the next 6 months.
Right.
And they also talked about increasing the amount of money they were going to commit to mortgage-backed securities, CDOs, and this kind of thing. I think they increased it to $1.25 trillion. So then you have this new thing from the administration, the Public-Private Investment Plan, the PPIP plan. And they're going to extend that even more, working with private capital to be able to buy a lot of these toxic assets off the bank's books. Mm-hmm. I think it's a good idea. Of course, there's a lot of devils in the details. That's why it was scuttled in the first place when Paulson and Company had put this thing together originally. They realized, how are we going to price this thing? And they looked at all of the downside risks, and they decided, forget it, let's just give the banks a bunch of money. Sadly, well, first off, we have no idea how good it really worked, because if we didn't do it, who knows how bad things would have been. So they probably did have some benefit doing so. Mm-hmm. But now, the very thing that they wanted to do in the first place, they're going to try and enact, and it looks as if the market is excited. But again, everybody is worried, how are you going to price these assets? If you price them too low, that means these other banks and everybody is going to have to do further write-downs. Right. If you price it too high, the government and other companies are now left holding the bag. So the devil is in the details, but so far the market reaction is enthusiastic.
Yeah, Kevin's right. There's a lot of devils in the details here, but something had to get the party started. Somehow we had to start getting private money in there, so it wasn't just the government's responsibility, and some process to start to try and price out the securities and make a market for them. And so the only way that the government was going to be able to get the private money in there was with a lot of guarantees, okay, which they certainly did there. But they did want the private folks to have some skin in the game. I think they have constructed a reasonable way of doing that. And so now what the market is applauding is that this is yet another piece. They're coming together. So not any one thing here is perfect, okay? But the pieces are starting to come together for what seems to be a reasonable package to help solve the myriad of problems that we have. And this one has been the one hanging out there. Gaitner, I think, has redeemed himself a little bit, because he certainly got off to a rough start. Gaitner, whatever the heck his name is. But he, this plan is being obviously very well received. Right. You take a look at the bullish run on the market this morning. I think this is a good start to, or another nice piece in the puzzle. Yeah.
Right. Tracy, how about you?
Well, my problem with it is that, like you said, the devil is in the details, and we don't know, what hedge funds are going to be in it, what private equity, I guess they're looking at sovereign wealth funds. Is it going to be Singapore, Dubai? Are they willing to go in there? And as you said, at what price? Nobody still knows what price. So it could be months before we actually see the results of this. But I do think it's good that we're getting, some kind of plan out there. Everyone knew that somehow these assets had to be, we have to find a market for it in order to fix the problem. It has to be. Well, and whether or not it's like 30 cents on the dollar, 70 cents on the dollar, some of the banks like Citigroup, not that long ago, was still valuing at 80 cents on the dollar. Right. Well, at some point, it's not going to probably be that.
And if they're not priced where the investors want them, are the investors even going to want to participate?
Well, that's another thing.
What's interesting, I had heard that PIMCO had said that they were interested in this, and they were excited about the potential to potentially earn a double-digit return. Now, who knows how long it's going to take to be able to see that, but you got some very big people and some very smart people out there saying, hey, yeah, I'm in. So I think that's a good show of confidence.
Okay, that is a good start. So now this news this morning, and we're taping this on the 23rd of March for those of you following the calendar. On the 20th, which was Friday, stock market, all three of the major market indexes closed at 3% or better. Second consecutive week that the market closed on the upside. So this news comes on the heels of that. That alone was a key achievement for the stock market. Are we beginning now to see the bias trending upward here over at least the near term?
Yeah, it's funny. The market had been coming up for a week and a half, 2 weeks, coming into last week. And I don't know a single investor who thought that was anything more than a bear market rally. However, there is now new information that's starting to have some of us say, potentially this could work. Potentially there's a reason for things to look better in the future, that we could be slowing the rate of our decline and that maybe seeing the growth out there in the future. And the first thing was the $1 trillion the Fed said they would buy up, mortgage-backed securities and treasury bonds and things of that nature. That was one nice piece of the puzzle. And what people don't realize is not just about bringing down the rates of the funds. The other part is by pushing out individual investors, by the government putting that money in, they're saying, hey, you guys take your $1 trillion and you invest it somewhere else in the economy, whether that be buying equities, whether that be making new plants, making a loan somewhere else. What they're trying to say is you use your $1 trillion and you do something good with it and not just have treasury bonds. So now you have that was a nice piece, this is a nice piece. There is a reason for a little more optimism. But we do need to keep our optimism in check. Will these things work? Will the market continue to rise? That's the great unknown. In the 1930s, or early 1930s, there were 6 market rallies of 20% or greater. And each one failed and failed and failed, and new lows were found. And I have no doubt that during that time, the government was out there trying to enact new programs, get on the radio. They didn't have TV back then. get on the radio and tell people the fireside chats and whatever else that things are going to be good. And they weren't, and they weren't, and they weren't. So a little bit of cautious optimism. It could be bottom, but keep in mind, we dug ourselves a big hole. Right. These things may work and may not. I would proceed with caution.
Tracy, does this rally have lasting power?
I think for longer than what people are saying. I saw some data in the Wall Street Journal today that said the average bear market rally during this bear market has only been 5 days, which has historically been really low. So, is this one going to last a little bit longer into like the 20, 30, 40 days? Maybe. And I also say that because I saw Governor Howard Dean on CNBC Squawk Box this morning talking about how we're going to retest the lows and then admitting he didn't know anything about the stock market. So
was he screaming when he said it?
Well, no, but this is like a contrarian indicator that there's people who who even admit they don't know much about Wall Street and what's going on, calling that we're going to retest those lows. So maybe, and we probably will, but it might be a lot longer out there in the distance than what people think for this rally.
Well, if anybody can tell us, it's Kevin, if we're going to retest those lows or not, because he's the technical mind here.
So ask me, are we going to retest?
How are we going to?
It's interesting. Last week the market closed 15% off of the lows. I think we got as high as 20% off the lows intra-week, but then by Friday we were like 15% off the lows. So today's move, we are back to near that 20%. I do think there's probably more to the upside if we can make a convincing move past that 20% threshold. And again, when the market was getting beat down, there were some very, very good companies that shouldn't have had so much value stripped out of them. So there's a lot of great companies that you're seeing a lot of outsized gains. But again, seeing the details of this plan, it's one thing unfreezing the markets, but then you have to find people who are willing to assume debt, who can afford to assume the debt. I mean, it was one thing giving loans to people who couldn't pay it back. Now we got to find people who actually can. So but we'll see.
So does this mean you're going to start screening for bank stocks now?
We're going to start screening for qualified creditors.
Okay. There you have the latest thinking on the latest developments in this credit crisis and with regard to the stock market and its moves going forward. With everybody here at the round table, I'm Terry Ruffalo.